Welcome to Random Gleanings. I'm Chris. He's Jesse. We're going to talk a little bit today, Jesse, about defensive versus aggressive. How you feeling? You feeling defensive or feeling aggressive out there in market land?
Well, our portfolios would suggest that we are defensive. That football back there's got Mike Singletary's autograph on it, so we'll go with the middle linebacker position.
Yeah, defensive at this point makes sense. Let's look at some charts. First one, this is a 2-year chart, just looking back over the last 2 years. And I mean, you can see, what do you see there? It's rolled over, right?
It has. Peaked, I guess. Parts of the market peaked, I think, back in November of 21, and then
a lot of stuff peaked in February to May of 2021.
Some of that really, really fast-moving stuff out of COVID, crisis for sure did, and then the S&P peaked on January 3rd. So that's We have rolled over since November to January.
Yeah.
No
so next chart. Here's a chart of year to date. You can see the Dow Jones Industrials are down 16. The S&P, and this is as of this morning of the day is June 23rd, Thursday. Down 21, and then the NASDAQ sitting right on down 30%, though it's acted a little better the last few days. The interesting thing, and this has to deal with the fundamental side of research, okay? The big question is, where is the market trying to land, and it's pretty fascinating, really. There's a rule that Nick Colas from DataTrek shared with us called the Rule of 20, right? Which is what?
Well, we talked about it a couple episodes maybe ago. It is the idea that a longer term projection of inflation rate, which is broadly accepted by the measure of what the tips are paying.
Treasury inflation protected securities.
That's right.
Which is from the U.S. Treasury.
That's right. So that plus the market multiple, which is the price to earnings ratio, ought to add up to 20.
Right. So 10-year tips have been between 2.5 and 3 this year. So, I mean, which is kind of crazy. I mean, with inflation, CPI up in the 8s, to think that 10-year tips would be in the 2.5 to 3 is kind of crazy. But suffice to say, that's where we are. So it seems like 17-ish ought to be about what a PE multiple should be, right? PE is price to earnings multiple, earnings per share multiple on the S&P 500. So let's look at earnings per share over on the left-hand side. The last 4 quarters of earnings have added up to $216, call it per share, of the S&P. And so if you take that $216 as the denominator and where we were trading this morning, which was $37.80, that puts you dead on a 17.5.
Pretty crazy.
Multiple. It would seem between 17 and 18, I mean, there it is. We're
priced right now for the trailing 12 months. Earnings.
12 months.
Right.
That's right.
Right.
So what this chart also says is if you thought we were going to get an increase in earnings from here, which, by the way, a lot of analysts still have not brought down their numbers, despite inflation, despite supply chain issues, despite slowing consumers,
raising interest rates,
despite raising interest rates.
So real quick, let's just talk through that real quick. That 9% rise in EPS is what analysts are still suggesting currently
would happen
will happen through the remainder of the year.
Right. So, I mean, if you thought that was going to happen, then, which, by the way, I don't think it's going to happen.
I don't think that's going to happen.
Yeah. I mean, you would imply that those numbers would be higher. Now, the reason on the right-hand side of the chart we have 16 and 14 in there is because in both the bottoms of 2018 and the COVID bottom in 2020, the market got to about a 16 multiple at that point, okay? The valuation low referenced is back late 2011, early 2012. The market traded at about a 14 multiple, okay? But lately, 17 to 18's been about, seems about right. All right, so if you think we're going to have a recession, let's go to the next chart. If you think we're going to have a recession, if you think we're going to have a drop in earnings, maybe we don't have a recession, but we still have a drop in earnings, right? let's just say we have a 10% drop in earnings from 216. That puts you at about 194. So if you apply the same logic, it would put you in a window between 3298 on the S&P and 3492, right?
33 to 3,500, right? And that's not higher than we are today.
All right, so if you consider 3,400 being the number, then that's roughly what? From 3,780, that's 10 to 11% down from here, right?
Yeah, that's right.
So, seems to me that's reason to potentially be defensive.
Keep the defense on the field.
That's right. That's exactly right. And to this point, technically nothing's broken out. Certainly, any type of quantitative comparison hadn't broken out to this point. So,
real quick, you've mentioned now fundamental, quantitative, and technical. Those are the primary components of how we approach risk management. I think we've just done a video. You want to talk about that for a second?
Yeah, so we've done a video for our clients on our risk management process, as well as if you are a prospective client, if you're out there trying to consider how to manage wealth, certainly we'd be happy to send you that video, but you'll have to ask us for it directly. We're not going to post it out there on the website, but ask for it if you'd like to see it. Happy to share. So, the interesting thing is as we get toward the end of the first half of 2020, this last little bit, it would be a logical time to see some, pension managers, et cetera, rebalance portfolios, right?
That's correct.
Maybe buy some stock. We've certainly seen some of the NASDAQ names just get crushed, as we've already referenced. There are some times when markets go up in the middle of a bear market, right?
Yeah, there are. First, before we look at bear market rallies, I saw this interesting chart about peak to trough. Once we've hit a bear market, right, which we logged, I guess, last week or a week and a half ago. And so I found this very interesting because a bear market is ticked by a down 20 off the high, right? So real quick on that, on this chart, you see how long it took to get down 20, and then the final column talks about days to the bottom after getting down 20. And really, there's not a whole lot of conclusive evidence as to, once it hits 20, everything turns around, because there are examples where it does, and there are examples where it most certainly does not, which is why I think it's important to understand, these bear market rallies, right? Because those can be head fakes that get us into the market maybe a little late, or, continue to keep us out of the market. And in fact,
so before we go to bear market rallies, let me just say, in this chart, days from down 20 to the bottom, an average of 131 days. that would imply another 4 months once we hit that negative 20, right? Although there's no way to know, right? Because some you got a couple 1 day, and then 11 days, and 30 days, and 46 days. But the rest of them are all, like almost half a year to even, a year and a half. That's a long time.
It can be a grind. So I think again, to me, it is important to understand, particularly when there are dollars involved. We've got to stay disciplined to the data, right? Which is where I'm going with this bear market rally. To all of the things that you've just talked about in regards to our risk management process, there are opportunities, there are technical signals, there are quantitative kind of indications that, hey, we have hit an opportunity for things to improve here that increase the probability for the chances for things to do better, right? But I think because that rollover that we started with from where markets are, the trend is still down right now.
Yeah.
It definitively. Is. And so we've got to be careful. We've got to be cautious in our entry points of layering in, but we also want to participate in these things.
Yeah. It would stink for a bear market rally to go up 19% and not participate.
Not get any of that.
Right.
That's exactly right.
And certainly right around the end of the month, that's often a time when you will see some pickup occur. So, we're in a defensive spot. You had a great song quote the other day, not happy yet, but way less sad.
That's right, AJR.
I like
That's
it.
right.
I like it. All right. So I thought, changing the subject somewhat, I thought, we're toward the end of the first half of the year. It's a good time for a sort of a channel check, if you will, on where you are in your household for the year. Let's first look at 401k limits. The 401k limits, Jesse, are...
Yeah, so a 401k limit is $20,500 for folks that are under 50 years old. You've got an additional $6,500 that you can add if you are above 50, a catch-up contribution they call that. So you can put in for the year $27,000.
So 10,250 would be the halfway point if your goal was to max for the year. So if you're at $10,250 into your 401k thus far, then you're right on track for maxing. If you're like me, 50 plus, at least, coming up later this year, then your halfway point would be $13,500. So take a look. Where are you? One of the most important things we think you can do is max your 401k. It's protected from creditors. It's if you're using traditional, it's a way to lower your taxable income. If you're using Roth, I mean, goodness gracious, you're saving money to have tax-free later in life.
And if there's a match, you got to get it.
Yeah, got to get that match.
That's right.
Get that bag. All right, next thing. Talk to your CPA, right? Are you still on the same taxable income trajectory for this year? Yeah, I mean, if you're on track, just want to make sure you don't get any tax surprises at the end of the year. And then finally, tax loss harvesting, right?
Yeah, a problem we didn't have last year, but that has been made available this year. There's some strategy around that.
Yeah, so tax loss harvesting is the notion of selling one taxable investment and buying another one that's similar, assuming you want to stick to the same strategy, in order to realize that capital loss. So it's kind of effectively making lemonade out of lemons, even though the original investment you own probably isn't a lemon, but it's at least an ability to get some benefit out of it. Now, you don't have to do that in IRAs because you're not going to get any tax loss capability to harvest losses there, where you will with taxable money. So those are all things that seem pretty useful to talk about right here at the
Yeah, I think, and just to hammer home one of your favorite things is, if you had a goal to save a certain percentage of your income for the year, again, we're at the halfway point. So if it was saving 20% of household income, see where you're at. Just check those numbers because, again, future you will not be upset that you've saved a higher percentage.
That's right. I mean, know what percentage you've saved. And if you ever want a little worksheet on how to calculate that, we're happy to send it to you. It's one of the items we're super passionate about. That's all I got.
Quick happy birthday to my wife. Love you. And that's all I got.
We love you, Angie. Thank you to those who have subscribed. Please, by all means, continue to subscribe if you haven't. Feel free to share if you feel like this is good information. Certainly, we want to make sure that we're helping as many folks out in the YouTube world as possible. So thanks as always.
One final note too, got a lot of comments. We do read your comments and emails about our charts. If you haven't heard me say it before, those are on our website through our Random Gleanings Insights page. So if you want to get a closer look at any of the charts that we've ever put up, they're all there, and dig in. They're ready for you to look at. Thanks.
Awesome. Thanks so much. We'll see y'all soon.
Take care.